More than 1,000 investors and traders came to get answers about what's coming at last week's 2024 MoneyShow Toronto. And to help them, I sat down with Benjamin Tal, Deputy Chief Economist at CIBC Capital Markets, for a fireside chat on market conditions and the road ahead. Benjamin, thank you so much for joining. I know there's a lot to talk about when it comes to the big picture for Canada's economy, the political backdrop, monetary policy outlook, and everything. So if we were just start from the view from sort of 30,000 feet up, where are we in this economic and market cycle?
Yes, interesting. I think that many of you by now must be very disappointed because everybody promised you a recession in Canada and we didn't get one. Well, let me tell you one thing. We are in a recession. We are in a per capita recession. Per capita recession, the Canadian GDP has been going down, negative for the past 5-6 quarters. So the only reason why the overall economy is still barely above zero is because of the fact that we got 1.5 million people into this country over the course of breakfast. That's the only reason why GDP in Canada is still positive. And that's not a way to grow an economy. You need GDP per capita to expand. And that's not happening. So clearly, we are in a per capita recession. The economy in the last quarter was surprising on the upside, 2.5%. But what we are getting into the third quarter is something along the line of 0.5%, very close to zero. The Bank of Canada is already recognizing that the economy is slowing down. Clearly, the labor market is slowing down. So the Bank of Canada is willing and able to continue to cut. The only thing that was complicating the picture was that this US economy was extremely strong, was refusing to slow down. And lately, as we all know, it is slowing down under the weight of higher interest rates. So with the US slowing down, the Fed willing to cut, the Bank of Canada has the green line to continue to cut. That's more or less where we are, very close to a recession, per capita recession for sure.
So let's talk a little bit about interest rate policy. As we're speaking, obviously there were already 2 rate cuts earlier this year. We've just seen a third from the Bank of Canada. How do you see the BOC moving forward from here? And what did you maybe pick out in the commentary today that kind of implies something about the future?
Yes, I think that the Bank of Canada is on a cruise control now. They will continue to cut every meeting, the next meeting and the meeting after that, which means that overall we are going to see rates going by another 50 basis points by the end of the year, and they will continue to cut interest rates in 2025. That's automatic. As I said, what was complicating the picture was the Fed. The fear until a month or 2 ago was that the Fed will not cut at all this year. And the Bank of Canada, can you divorce yourself from the Fed? What does it mean for the value of the Canadian dollar? Now the Fed is tweeting about their willingness to cut. Some people say by 50 basis points the next meeting, as you all know. So clearly the Bank of Canada has the green light. They clearly will continue to take advantage of it. The Fed is not limiting them in terms of their ability to cut. And there is all the reason to cut when it comes to Canada. As I said, we are in a per capita recession. Inflation is no longer a story. If you take inflation minus mortgage interest payments, it's basically 1.5 below target. In fact, the Bank of Canada is starting to talk about the possibility of inflation going below 2%. And basically, they're telling us our focus now is the 50% risk that it's above and 50% risk that it's below 2%. So a year ago, everybody was panicking about inflation, and we all knew that it was not about inflation. It was about the cost of bringing inflation down to 2%. And I submitted in the past that this cost has been way too high. Namely, the Bank of Canada was overshooting, and that's exactly why they have to undo the damage and continue to cut on a regular basis. So I see the Bank of Canada cutting. I see the Fed cutting starting September. Now, the question is by how much? Namely, what will be the terminal rate as far as the Bank of Canada is concerned? I believe that the Bank of Canada will go down to about 2.5, maybe even 2.25. This is a bit below their neutral rate. And the reason is the following. We need the 10-year rate and the 5-year rate in Canada to go down. Those rates are determined by the market. And the market now is pricing the Bank of Canada to take rates to about 270. So if you go to only 270, the 5-year rate that is so important to the housing market and the 10-year rate that is important for everybody else will not move from then. That's not good. The Bank of Canada needs to see them going down. Therefore, they will have to go below what the market is expecting. And that's why I say 250, maybe even 225 by the end of 2025.
In the U.S., we obviously talk quite a bit about the debate, soft landing, hard landing, no landing. And I know some speakers have fallen down on one side or the other of that debate. How would you describe the severity? If you say that Canada is sort of in this borderline recession anyway, how hard do you think the landing could get?
Yes, I think that the reason why the US economy has been outperforming and not crashing is because of the fact that they are less sensitive to higher interest rates. They don't have as much debt as in Canada because they went through the mother of all deleveraging during the financial crisis. And their mortgages are for 30 years. Our mortgages are for 5 years. So when interest rates go up, we feel the impact immediately. In the US, wake me up when it's relevant. So the impact on the US economy and the US consumer and investment is not as significant as it is in Canada. And therefore, interest rates in Canada have to be higher than interest rates in the US when you end the cycle. Now, where are we with the Fed? Until now, the Fed was basically talking about the possibility of not cutting at all. The market was talking about no lending or all these scenarios. Now we know that if you look at the labor market, it is slowing down. If you look at the quit rate, if you look at employment, unemployment, everything is moving in the right direction. When I say right direction, I mean slowing down. Because bad news is good news as far as the market is concerned, because you need to see the economy responding to higher interest rates, and that's exactly what's happening now. So the Fed will cut by 25, another 25, and maybe another 25 this year. So altogether 50 or 75 basis points, and will continue to go down in 2025. That's a given. I think that we have a situation in which the economy will be responding, the economy is slowing down, and I do believe that we can achieve with lower interest rates a soft landing. And if you want a scenario that is similar, it's the 1995 soft landing. Back then, the Fed raised interest rates by 300 basis points. The economy slowed down, but landed beautifully, very softly. That can happen. That can happen, and I think that we are seeing a trajectory to achieve this kind of target. I don't think that the Fed will go crazy with interest rates, but a 50 is a possibility in September or after.
I feel like we have to talk about it, just given where we are in the political cycle in the U.S. as well as in Canada. There's been quite a bit of discussions about the elections coming up and what that might mean in terms of fiscal policy and impact on the economy. Any thoughts there on what investors should be watching out for, or on how you see things shaking out over the next year or two there?
Well, a lot, of course. There is going to be a lot of volatility when it comes to the elections. Listen, I don't know who's going to win. Nobody knows. It's 50-50, so I'm not going to speculate. But if Trump wins, we have a few things here. It's going to be taxes, it's going to be trade, and it's going to be regulations. Taxes will be basically cutting corporate taxes and making personal tax income relief permanent. So that's something that is a given, and Canada will have to respond, especially when it comes to businesses and taxes on businesses. The most important story is trade. If you look at what the Trump administration or the future Trump administration is talking about, we are talking about a significant trade war, deterioration. They will go after Mexico, they will go after Canada, and clearly they will go after China. Now, we have to remember that if you look what happened between 2016 and 2020, when Trump was the president, we have seen exports from China to the US going down dramatically because of tariff. It worked. However, exports of other countries to the US went up. So it's not deglobalization, it's reglobalization, it's reallocation. Now, so we have Vietnam, we have Malaysia, we have Mexico, we have India. All those countries gain market share in the US at the expense of China. Now, guess what China is doing? If you look at China's foreign direct investment and exports to those countries, it went up to the sky over the past few years. So basically, they are entering the US through the back door. It's a trade policy by proxies, and Trump knows that. And therefore, he can go after Mexico, India, Malaysia, Vietnam, in addition to China, and that will make things more complicated. He also might go after Canada. We also have to remember that he wants Canada to spend more on defense. Clearly, the budget deficit in Canada will be rising. And regardless who wins, Harris or Trump, we have a situation in which the budget deficit will widen. Trump is all about taxes and spending, with taxes is the main focus, and clearly that will widen the deficit. Harris is spending and tax with a focus on spending, again, will raise the deficit. Regardless what you're going to see, the long end of the curve will suffer because of those policies. So a lot to anticipate. This is going to be very, very interesting, economically speaking and clearly politically speaking.
Understood. In the second half of our conversation, I wanted to pivot to some of the impacts on markets here. Maybe starting with Canadian real estate, since we're obviously focusing on interest rates. You had an interview with Canadian mortgage professional back in July and talked about there being almost a tale of two markets in Canada, and noting that every basis point is going to help with mortgage borrowers. How do you see that shaking out again at the back half of this year and as we roll into 2025?
Absolutely. A tale of two markets is right, because we have the low-rise segment of the market doing extremely well or relatively well, given the fact that interest rates went up by 500 basis points, still holding. There is demand there. There is a reasonable inventory. So the market is functioning in a normal way. That's the low-rise, detached segment of the market. The condo market in the big cities is basically dead, absolutely dead. I released with Urban Nation a study recently about how many investors are in negative cash flow, and about 80% of them are in negative cash flow, which means that there is no motivation to invest. So you don't have this demand that was there before coming from investors that are 50, 60% of the market. At the same time, builders cannot build. Why? Because of higher interest rates, the cost of labor, construction costs. They simply cannot afford building. So pre-construction activity is absolutely dead. You are not able to sell anything. So the only mechanism that is softening is the resale market in the condo space. And that's why the price gap between pre-sale and resale is at a record high. This is a frozen market. Now, this is a situation in which we haven't seen in a long time. What I'm telling you here is that if you are in the market for a condo, the next year and a half is the best time, because you have a window in which the condo market will be very weak. However, we are not building anything new. So 2 years from now, 3 years from now, when the demand is still there, the supply that's supposed to come now will not be there. You don't have to be an economist to predict what will happen to prices. So we have a window of opportunity in which the market is clearing. The market has to get rid of those inventories. The resale market will be softer and softer, a golden opportunity to get into the market, because the overall fundamentals of the market are still strong with immigration, demand, and limited supply. So that's what I see unfolding in the housing market, the low-rise versus the condo space, which is a tale of two stories.
Let's shift to the stock market then. I mean, as we're speaking, the TSX is about up 10, 11% on the year still, even with some of the recent volatility we've seen in the U.S. How do you see that shaking out? And, within the TSX, are there particular sectors that think, given your understanding or expectations for the economic cycle, could outperform or underperform?
Yes, I won't get too much into the stock market. Other people will do it better, I believe. But what I do want to say is the following. We are in a very interesting situation in which interest rates are going down. Now, if you look at what happened over the past year and a half, we have seen a situation in which GIC investment went up dramatically. There is a basically 95% correlation between GIC volumes, namely term deposits, and interest rates. So when interest rates went up to 5% GIC rate, everybody was there taking money out of equities or sacrificing money that was supposed to go to equities. So the equity market was actually suffering because of that, not just because of the punishing impact of higher interest rates, but also because of the movement to term deposits. People said, basically, I want to sleep at night, 5%, I'm happy. Now those rates are going down, 4, 3, at one point, maybe 2%, and it's coming. People say that's not enough. I'm going back to the stock market. Where in the stock market? Dividend-paying stocks, because there you still get 4 or 5%. So I believe that there will be a significant shift in asset allocations from term deposit, namely GICs, to dividend-paying stocks, and I would like to be part of it.
Excellent. I guess the other markets we haven't yet touched upon would be of interest to attendees here would be currencies and commodities. I'm curious about your thoughts on the Canadian dollar, as well as what you're seeing in the commodity market. We have kind of the split where oil's been struggling, gold's been hitting new highs, for example.
Yes, I think that gold is definitely reaching new highs and will continue to basically improve over the next year, I believe, or at least will remain elevated. The oil market reflecting some sentiment regarding the global economy. China is slowing down, the US is slowing down, Europe is still slowing down. We are in a transition period in which the economies are still reflecting high interest rates, and therefore the commodity market is telling you the economy is fine. It's not a recessionary economy, but the global economy is slowing down. Therefore, I don't see any significant recovery in the commodity market until mid to late 2025. The currency, I think that the Canadian dollar will remain vulnerable for the next few months. But at one point, and this point is getting closer and closer, when the market is sure that the Fed is very serious about cutting interest rates, that's something will lead to a relatively weaker US dollar in general against the yen, against the euro, against the pound, and clearly against the Canadian dollar. So short term, stable to lower. Beyond that, beyond the next few months, when the Fed is still in full swing, I suggest that the US dollar will weaken and the Canadian dollar will regain a few cents.
Benjamin, I always like to wrap up these discussions with a final question, and that would be, what would make you, more bullish on the outlook for markets and the economy, and what are maybe an unspoken risk or a risk we haven't discussed that would make you more bearish, generally speaking?
Yeah, I think that two things. One, inflation is always a risk, and it can come back, and something that the bank is not expecting, although that's a very low probability. So I say, no big deal here. Clearly, and everybody knows that the geopolitical issue is extremely sensitive. We have China, Taiwan, we have Russia, Ukraine, and of course we have the Middle East. So I don't have to tell you how fragile the situation is, especially when it comes to the impact on supply chain. So that's clearly a risk that everybody is aware of. I think that if inflation goes down more rapidly than expected, you will see interest rates going down more rapidly than currently anticipated by the market. That will be a boost to both equities market and the economy as a whole. So that will be the positive scenario.
Excellent. Benjamin, again, thank you so much for taking some time out here to discuss the markets and the economy with our audience, and I really do appreciate it.
My pleasure. Thank you.